Have you ever looked at the stock market and just felt, well, overwhelmed? Like it's some kind of game you can't possibly win. What if there was a timeless guide, like a blueprint, to navigate it all with calm confidence, turning chaos into clarity, maybe, building real wealth? Welcome to the deep dive. We take your sources, dig in, and pull out the absolute key insights. Today, we're diving into a true classic, Benjamin Graham's The Intelligent Investor. Decades old, but Warren Buffett still calls it by far the best book on investing ever written. Our mission: to unpack its core ideas and see why they're still so critical for, anyone trying to figure out investing today. And hey, before we really get started, if you find this useful, please do share it with someone you think needs to hear it. And definitely subscribe so you don't miss our next deep dive. It really helps us out.
It is pretty amazing, isn't it? A book from 1949 feels like a different world, but it still holds so much weight. So what's really at the heart of Graham's philosophy? What makes it last?
Okay, let's unpack this then. The whole approach seems to kick off with something called value investing.
Hmm.
What exactly is that? And how is it different from just buying stocks?
Right, value investing. At its core, it's about finding and then buying stocks that are selling for less than their real underlying worth, their intrinsic value. It's not about chasing hype or the next hot tip. Nope. It demands really thorough analysis, digging into the fundamentals.
Fundamentals
Like earnings, assets, debts, growth prospects, the actual health of the business. You're trying to figure out what the business itself is genuinely worth, separate from whatever the stock price is doing day to day.
So it sounds like hard work, not just following the crowd.
Exactly. It's about solid groundwork. And Graham draws a really sharp line here. He differentiates investing from speculating, big time.
Okay, investing versus speculating. What's the difference in his eyes?
Investing, for Graham, is based on that deep analysis. It promises safety of your initial money, your principal, and an adequate, not necessarily spectacular, but adequate return. Speculating, though, that's buying based on hoping the price goes up short term, often driven by market sentiment, maybe a rumor, not by the company's actual value. Graham warns against it. He really pushes for that disciplined, analytical approach. That's the path to real financial freedom, he argues.
Right. Now, here's where I think it gets really fascinating. Graham uses this metaphor, this character, Mr. Market.
Yeah.
Who is this guy, and why is he so important for us investors to get our heads around?
Mr. Market. He's brilliant. He's this hypothetical business partner Graham invented. Imagine this partner shows up every single day, and every day he offers to either buy your share of the business or sell you his share. But his prices are all over the place, completely wild swings based on his mood. One day, he's incredibly optimistic, euphoric even, offering sky-high prices because he thinks everything's amazing. The next day, he might be utterly depressed, convinced the sky is falling, and offer you rock-bottom prices. He's, let's say, emotionally volatile, not rational.
Okay, sounds like a handful. A bit like the market itself then, right? So, what are we supposed to do with this moody partner? How does the intelligent investor handle Mr. Market?
Well, the key is you don't let his mood dictate your actions. Intelligent investors should see Mr. Market's irrationality as an opportunity, not a threat. When he's pessimistic and offering low prices, that could be a buying opportunity for you if your analysis supports it. When he's overly enthusiastic and offering crazy high prices, maybe that's the time to consider selling.
So you use his moods to your advantage.
Exactly. You're in control, not him. You decide if his prices make sense based on your own research, your own valuation. The absolute critical thing is avoiding letting your own fear or greed take over in response to his swings. That emotional discipline. That's vital for long-term success.
That makes sense. And it leads nicely into another core Graham concept, this margin of safety.
Yeah.
It feels like, I don't know, a safety net for your money. What is it exactly?
It's probably Graham's single most important concept for protecting yourself, the margin of safety. It simply means buying an asset for significantly less than its calculated intrinsic value.
So that gap we talked about earlier
Yep.
between price and real worth.
Precisely. That gap is your margin of safety. Let's say you carefully analyze a company and figure its true worth is around $50 a share. A margin of safety means you wouldn't buy it unless the market price was, say, $30 or $35, maybe even lower. That difference, that $15 or $20 buffer, that's your cushion.
A cushion against what? Things going wrong?
Exactly. Against errors in your own calculation, which can happen. Or against unexpected bad news, unforeseen events hitting the company or the market. It provides crucial protection against the risk of losing your capital permanently. The bigger the margin of safety you demand, the lower your risk. It forces you to be patient and buy only when the odds are strongly in your favor. It really makes you ask, how much protection am I building into my investments? Am I leaving room for error?
Okay, that's clear. Now, Graham also knew that not everyone wants to or can spend all their time analyzing stocks like that. He talks about two kinds of investors, defensive and enterprising. Can you break those down for us?
Sure. He was very practical about this. He knew people have different temperaments, different amounts of time. So the defensive investor, this is generally for someone who is able or willing to put in a lot of time on research. Their main goal is avoiding serious mistakes or losses. Yeah. And getting, reasonable, stable returns.
What kind of strategies would they use?
Think diversification. Spreading money across a lot of different solid companies. Maybe focusing on large, established companies with long histories of profit and dividends. Index funds are a classic defensive tool. You buy the whole market, basically. And dollar cost averaging is another one. Investing a fixed amount regularly, no matter what the market's doing. It smooths things out, less stress, less effort.
Okay, that's the defensive side. What about the enterprising investor?
The enterprising investor.
Uh-huh.
Well, this is someone who is willing to put in the extra time and effort. They're actively looking for those undervalued situations, doing the deep analysis needed to potentially achieve higher returns than the defensive investor.
Yeah.
This requires more skill, more research, maybe looking at stocks that are out of favor or special situations. It's more demanding.
More potential reward, but more work and maybe more risk if you get it wrong.
Potentially, yes. It requires genuine business acumen and a willingness to go against the crowd based on your own thorough research.
All right, so thinking about those two approaches, defensive and enterprising, maybe take a moment now and consider which one feels more like you right now. And thinking about Mr. Market, what's maybe one change you could make to how you react to market mood swings? Just something to think about. Pulling all this together, understanding Mr. Market, demanding that margin of safety, choosing your investor type, it feels like it all hinges on one final crucial element: property. Graham stressed patience. A long-term view. Why is tuning out the daily noise and just being patient so fundamental?
Oh, absolutely fundamental. Graham was adamant that successful investing isn't about timing the market perfectly or reacting to every news headline. That's a losing game for most people. He really pushed for a long-term horizon,
Yeah.
years, even decades.
So ignore the noise.
Pretty much. Focus on the businesses you own, their underlying performance, their fundamentals. If you've bought good companies at a sensible price, with that margin of safety, then you need to give them time. Time for their true value to be recognized by the market. Time for compounding to work its magic. It requires real discipline. Patience is the discipline here, resisting the urge to constantly fiddle or react emotionally.
It really does sound like a shift away from the get-rich-quick mentality that you see so often. It feels like a genuine transformation in thinking about how wealth is built.
Exactly. It's about building wealth sustainably, responsibly, like being a part owner in real businesses. That long-term view, combined with value principles and the margin of safety, that's the foundation for steady, reliable growth, rather than chasing speculative bubbles.
And it's just amazing how these ideas born in the 1940s still feel so incredibly relevant today. With everything happening now, crypto, meme stocks, super fast trading, Graham's core ideas seem almost more important.
I completely agree. The technology changes, the market players change, but human psychology, fear and greed, they don't change much. Mr. Market is arguably even more manic today with the 24/7 news cycle and social media hype. So Graham's emphasis on rationality, on analysis, on patience, it's timeless wisdom. It cuts through the noise. And look at its legacy. The fact that someone like Warren Buffett constantly points back to Graham as his mentor, that tells you everything about the enduring power of these principles. They just work across different eras.
And you mentioned updated editions, right? That helps make it accessible now.
Yes, that's a great point. Newer editions, especially the ones with commentary by people like Jason Zweig, are fantastic. Zweig's notes provide modern context, current examples. They really bridge the gap from Graham's time to ours. It helps ensure these crucial lessons keep reaching and guiding investors today.
So wrapping this up, what's the big takeaway for you listening right now?
I think it's that even when markets feel chaotic or overwhelming, there is a path. A disciplined, rational way to build wealth. It's maybe less about being the smartest person in the room and more about being the most patient, the most methodical.
Well said. And maybe the bigger picture lesson from Graham is that investing success isn't really about outsmarting everyone else. It's much more about understanding yourself, controlling your own emotions, your own reactions. That's a profound insight, really. It's about behavior. Couldn't agree more. Remember that quote. By far the best book on investing ever written. Warren Buffett said that. Let that sink in. This isn't just stock tips, it feels more like a philosophy, a road towards genuine financial freedom. So, our final question for you today: what part of Graham's philosophy, Mr. Market, the margin of safety, patience, maybe the investor types, what resonates most strongly with you? And how might you apply that to your own financial journey? We'd love to hear your thoughts. Thank you so much for joining us on this deep dive into the intelligent investor. We really hope it empowers you to approach your investments with maybe a bit more confidence and clarity. Please share this deep dive if you found it valuable, perhaps with family or friends, and we'll catch you on the next one.